G'day guys, we're going to start talking about the tax on investment earnings. A lot of people wonder who should own what and why when it comes to investing, and accountants will often talk about the tax rates that apply on the earnings of an investment that you purchase. So in this example, we're going to use a property, but it works equally the same for a share portfolio. We're not going to talk about added tax incentives of each of those different investments. We're just going to talk about what the general tax is on those investment earnings at a headline level. So the first thing we need to establish is that with investing, there are two types of returns that are most common. The first one is income. Income in the form of the property example we're going to give would be rent, and likewise in the share it's a dividend. And then we've got growth. Now the growth is the change in the price of that property, and that comes around upon sale. Okay, so when we sell that place, if we buy it for 500 grand, we sell it for $1 million, we've made $500,000, and that would be considered the capital gain. So they're the two types of returns that we're most concerned about and what tax gets applied to them. Let's talk through the different entities that can own it. I'm just going to do the main ones that most people would be aware of. We're not going to do an exhaustive list, but one of the most common ones is, of course, in your own name. We can have a husband and a wife, or we can have one or the other. What we can do is own it in an investment company, so a company that holds your investments on your behalf. We also can have a family trust. That's a common one that a lot of people have, and a family trust is useful as it can pass tax down the lowest path of resistance. So it's a nice minimisation strategy. And the last one we've got is superannuation, but there are two halves to the super equation. There's super that's in accumulation phase or still building it up, and then there's superannuation that's in pension phase and we're drawing it down. So generally speaking, that is beyond the age of 60. So as we talk through the tax rates that apply in this scenario, we would look at a marginal tax rate for an individual. So the marginal tax rate in Australia, the way it works is that the more you earn, the more you pay. So if you have a low income, you have a low rate of tax, you then earn a bit more, you'll step up a bracket and you'll start to pay a bit more. And eventually you can get as high as 47%. The average is much closer, sort of mid-30s. So 47% is the highest, and 35, something like that, might be around about an average. That hasn't been checked by the Australian Bureau of Statistics, but in our experience, people we're talking to about investing usually start at that and only get worse. Okay, so that's the income that you might be paying on the rent. Okay, we're not talking about after. This is after any deductions that have been applied. That's just the additional, the surplus cash flow that thing has generated. If we have an investment company that owns that property, we would have the rent coming into that company and it pays expenses. The profit on that, so to speak, would be taxed at the marginal tax rate. Sorry, the profit on that would be taxed at 30%. An investment company pays 30%. A trading company would be 25%. So a small company in Australia that's trading and you might be operating a business via that, it would have a tax rate of 25% applied. But we would always caution clients not to invest and buy properties and things like that in their trading entities, because then you're mixing your business risk with your personal wealth. We don't want to do that. We'll have more on that in the future in other installments of these little snippets. A family trust is the next one. A family trust is quite interesting. As I said, they can split the income down the path of least resistance. What we're looking at there is they don't actually pay tax ordinarily unless they fail to distribute. So if they hang on to it, they'll pay the top marginal tax rate, but generally speaking, they will shift that money into either an individual's name or an investment company's name. So at the end of the year, it distributes to one of those entities. So I'll draw the arrow to the left to say it's going to eventually end up in one of those boxes, and one of those rates will apply. So if we have a super fund that owns a property, that property rent will get taxed at a maximum of 15% whilst you're in accumulation phase. So if you're building your money up and you're a 40-year-old and you've got that investment property in there, and it's rents stacking up, for every $100,000, you'll have $85,000 left over to go and reinvest or potentially pay off the debt attached to that home. So there's quite a low rate of tax there. You can imagine that looks attractive. Well, when you hit age 60, if you then go to pension phase, you then have the opportunity to enter into the tax-free realm under the current legislation. So that's fairly attractive for an investment strategy. I can imagine how attractive 47% is by comparison to zero. It's ugly, right? It's very unattractive. You're not going to want to do that. But there are some incentives and reasons as to why you might want to own that in your own name. The first one being access to the sale process of that property. If they're in super, you can't get to them, right? So we might need to have some money outside of super. That's on the growth side. On the income side of things. So that is on the income side of things. Let's talk about the growth. We've owned the property for a number of years. We're going to sell it off. The first thing we need to understand is if we own it in our own names and we've owned it for longer than a year, if we sell it for a profit, we then are able to attract a discount of 50% on that capital gains assessment. So using the example I had before, we bought it at 500,000, we sold it for $1 million, we now have a $500,000 profit. That would well and truly put us up into the top marginal tax bracket. We would have 50% of that growth free and 50% of that taxed at your marginal tax rate. So that mathematically is the equivalent of saying your growth is taxed at half the rate of your income. So if we apply it like that, we're sitting somewhere in here and maybe around there on average. But generally speaking, when we have that growth, it puts us up a bracket fairly fast. So you would expect that that average would climb very quickly. In the company, it doesn't matter if it is income or growth. It's all just taxed at the same rate. So we'd be sitting at 30%. The family trust is going to distribute that capital gain to somebody on the left or the company on the left, and then those rates would apply. Interestingly enough, if we have that family trust and it distributes, don't worry about that. So we also then have superannuation. Superannuation is only 2/3 assessable on the gain, so a tax rate of 10% applies. So that's quite attractive. And then once again, 0% if we get beyond the age of 60. The main catch is if we're operating in this environment of tax-free super, so we're sitting over here in tax-free super in pension phase, if we're in that phase, we are required to take a pension payment out. So we have to turn the tap on with your money and we have to pay money out each year. The thought process behind that is from a government standpoint, you're not accumulating money in a zero tax environment, you're actually taking it out as time goes on and hopefully stimulating the economy, and that money goes on and we start to then get tax collected at the government level there. So it works in the end for the government, it's just a delay strategy. So when you look at that table, you can imagine when you're talking to your financial planner, he is barely, or she, so you can imagine So when we look at that table, you can imagine owning things in your own name can be quite unattractive tax-wise. Owning things in super phase can be attractive, and in the pension phase, particularly of super, can be even more attractive. A general trend that you'll see is your advisor will be asking you to move your money that way as time goes on, and you're getting closer and closer to retirement. One of the best strategies that you can work on with your financial planner is having the right amount of money invested in your own name for pre-retirement savings and the right amount of money invested in your superannuation for your post-retirement phase, because the tax that you pay on your investment earnings really matters. Thanks for joining us.